Welcome to the Daily Consolidation, your essential daily briefing on Wall Street's most important moves, bringing you the market insights that matter, delivered right after the closing bell. Please note, this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in. So, Tuesday, October 28th, 2025. It really felt like a tale of two markets today, didn't it?
It absolutely did.
On one hand, you had this real celebration feel. U.S. equities hitting their third straight record close. A lot of risk-on sentiment, especially with the Fed meeting coming up tomorrow.
Right.
But, when you peel back the layers, that enthusiasm was, well, incredibly selective. It created this kind of strange contrast we should probably unpack.
That contract, that's really the core story today. You see the S&P 500 climbing, what was it, 0.23%, closed at 6,890.89, but that was almost all driven by, the big tech names. And then, at the exact same time, you have gold futures, the classic safe haven, just collapsing. It opened below that key $4,000 level, first time since October 13th.
Wow.
So when you see growth stocks hitting records while the insurance assets fall apart, it tells you something pretty significant is shifting in how the market sees future stability.
Okay, let's dig into the equity side first then, because those headline numbers, they really are something. S&P 500, Dow, NASDAQ Composite, all hitting new records.
Under record.
NASDAQ led the way up 0.8%, and the S&P, it even poked above 6,900 during the day, right?
Briefly, yeah. Kissed 6,900. It's the 35th record close for the S&P this year. So structurally, it still points towards a pretty bullish setup.
And the main driver today seemed pretty clear.
Oh, absolutely. It was all about NVIDIA, specifically CEO Jensen Huang's GTC keynote down in D.C. This wasn't just like a product update. It felt more like laying out a huge strategic vision.
Yeah, I thought the scope of that was fascinating. It wasn't just data centers and servers this time. It felt like he was talking about making NVIDIA tech the sort of central nervous system for almost everything, 6G towers, robot factories.
That's exactly it. They're essentially aiming to be the underlying tech for the entire future economy. And they gave specifics too, which the market loves. They confirmed the Blackwell GPUs are now in full production out in Arizona. It's a big deal for scaling.
Right.
And crucially, they announced that big 6G platform partnership with Nokia. The NVIDIA Arcarial RAN computer thing.
And Nokia just exploded, didn't it?
Flew up, over 21% surge for Nokia shares. It just shows how this AI leadership buzz is creating ripples, beyond just the chip companies themselves.
But doesn't that NVIDIA focus just amplify the concentration risk we keep mentioning?
Yeah.
I mean, if one CEO's speech can basically pull the whole market up,
yeah,
it feels a bit precarious, maybe.
It absolutely feeds into that concern. And we should circle back to the market breadth data in a second because it really highlights that. But first, there were two other big corporate stories today that show slightly different market vibes.
Okay.
We saw some M&A, kind of strategic consolidation, but also a pure momentum story.
The M&A was in semis, right? Skyworks and Qorvo.
Yes. Skyworks buying Qorvo. Stock and cash deal values the combined company around $22 billion. This is about building scale, efficiency, competing better globally. It's a smart, defensive kind of move.
And the market liked it.
Loved it. Both stocks jumped massively, somewhere between 17 and 19%. It's seen as good strategic sense.
Okay, and then the momentum play, that was PayPal. Seemed like they hit everything right today.
Yeah, a real triple catalyst day for them. You don't see that often. They reported strong Q3 revenue, $8.4 billion. They raised their full-year guidance, always a plus. But the market really latched onto two other things. First, that big partnership with OpenAI, integrating their digital wallet into ChatGPT. That's, positioning for the future.
Makes sense. And the second thing?
On top of all that, they announced their first ever quarterly dividend, $0.14 per share. That's giving cash back to shareholders finally, a really powerful signal.
So growth, AI relevance, and shareholder returns.
Exactly. That combination sent the shares up, 14% in pre-market? And they held on to most of that gain. It's like a perfect storm of what the market wants right now.
Okay, but let's go back to your point about concentration.
Yeah.
Because despite these amazing headlines, these record closes, the participation wasn't very broad, was it?
Not at all. And you see it clearly in the breadth figures.
The advancers versus decliners?
Precisely. You have to look under the surface. On the NYSE, advancers only beat decliners by about 1.74 to 1. Now, on a day with all-time highs across the board, that ratio feels pretty weak, honestly.
So the big guys are pulling everything up.
Exactly. Those huge mega-cap tech names are doing the heavy lifting, dragging the indices higher, but most other stocks, mid-caps, small-caps, they're kind of being left behind in this rally. The market's rising, sure, but it's riding on the shoulders of a very small group. That definitely adds a layer of structural risk if that leadership falters.
That's a really crucial point for you listening. Record highs don't always mean the whole market is healthy underneath. Yeah. Now, if that tech surge shows so much confidence in growth, what does that do to the things people buy when they lack confidence? We definitely need to talk about that break in precious metals. It's quite a divergence.
It really is, and it just shows how fast sentiment can flip. Gold had been the go-to hedge, for geopolitics, for inflation, for most of the year. But today, it felt like conviction that those tail risks are fading just caused a sell-off. That $4,000 per ounce level was the key one we were watching.
And it opened just below it, $3,999.90. That feels almost deliberately symbolic.
It does, doesn't it? Only 10 cents. But psychologically, $4,000 is huge for algorithms, for trader mentality. And once that breaks, you often see technical selling pickup speed. By mid-session, gold was trading down around $3,963. The market's basically saying, okay, maybe we don't need quite so much insurance right now. And we think we know why.
This seems linked to the U.S.-China trade situation, right? Some signs of de-escalation.
That looks like the main catalyst. Reports started coming out about officials reaching some kind of framework agreement on tariffs and other tricky issues during talks over in Malaysia.
And gold just reacted instantly.
Instantly. Remember, gold hit that all-time high, $4,381.58 just earlier this month. Now it's corrected almost 10% in, just over a week? This follows that massive 5.79% single-day drop we saw last week, too.
So for anyone tracking this, it's a really clear example of that inverse correlation principle, isn't it?
Textbook. Gold's value as a safe haven, as insurance, it just fades when investors start betting on peace and growth instead of conflict and inflation.
It's a classic risk-on move. Money flowing out of safety into riskier growth assets, which kind of confirms the story we saw in tech today. Okay, so that positioning for more certainty, for less risk, that takes us to the bond market. Fixed income, where today felt less about big moves and more about waiting.
Yeah, anticipation is the word. Treasury yields were remarkably stable. That's pretty typical the day before a Fed decision everyone's watching. The 10-year note barely budged, hovering right around 3.981%.
And that stability reflects the market being almost completely sure about what the Fed will do tomorrow, at least with the rate itself.
Near total certainty. Futures markets are pricing in a 98.3% chance of a 25 basis point cut. That would take the target range down to 3.75%, 4.0%. When the outcome is seen as that much of a done deal, volatility just evaporates.
Which we saw in the VIX.
Exactly. The VIX, the fear gauge, dropped again today, down another 3.5%, settled at 15.79. That's pretty low. It suggests maybe a bit of complacency creeping into the market's pricing.
And the credit markets, are they telling a similar story?
Mostly, yeah. Kind of mixed signals, but generally very tight. Credit spreads, the extra yield investors demand to hold corporate bonds instead of treasuries. They're still near historic lows. Investment grade at 78 basis points.
Which means not much perceived risk.
Very little perceived risk in the corporate world, exactly. High-yield spreads also tightened a bit more, down to 281 basis points. This ongoing tightness suggests the market thinks companies are resilient, fully priced for it. But you have to wonder, like you said about concentration, are they maybe overlooking some underlying risks if the equity market is so narrow?
And all this leads into the, really unique situation facing Jerome Powell and the FOMC tomorrow. People are calling it a double blackout.
It's genuinely unprecedented. You got the usual quiet period before the meeting. They legally can't talk policy now. But layered on top is this information blackout because of the ongoing government shutdown.
You're right. The shutdown means they don't have the latest official economic data, like the September jobs report, which is usually absolutely critical for their decisions.
Exactly. They're making policy without their usual bedrock of official numbers. Now, they do have private sector data, like the ADP jobs figures, which have shown some weakness, kind of supporting the rate cut idea. But still, Powell has to deliver forward guidance tomorrow with limited official visibility.
So how he handles that, how he talks about the lack of data, that's going to be almost as important as the cut itself.
Absolutely. It forces him to lean more on, let's say, qualitative judgment rather than just hard numbers. It makes tomorrow's press conference incredibly high stakes.
Okay, so let's pivot then. Looking ahead, The next 48 hours feel pretty defining for the rest of the year. Tomorrow, obviously, the FOMC decision at 2 p.m. Eastern, then the Powell press conference at 2:30.
Yep.
And since that 25 basis point cut is basically baked in, all eyes are on the forward guidance, right? What comes next?
Totally. The market will be dissecting every single word. 3 big questions, I think. 1, does the Fed hint strongly at another cut in December, or do they go back to saying, we'll decide meeting by meeting? 2, how does Powell explain away the data blackout without making the Fed sound like it's flying blind? That's tricky. And 3, what do their updated projections, the dot plot, say about the terminal rate for 2026? If they signal rates staying higher for longer than expected, even a rate cut tomorrow could feel hawkish.
And then, right after the Fed drama, we've got significant geopolitics on Thursday. President Trump's meeting with Chinese Premier Xi Jinping in South Korea.
Scheduled for October 29th, yeah. And the president has sounded pretty optimistic, saying he expects them to finalize a trade deal there.
So that's the second huge external factor this week. We already saw trade talk optimism hit gold today. A finalized deal would presumably turbocharge that risk-on sentiment even more.
You'd think so. It would be a major boost for global growth outlooks, likely reinforcing the trends we saw in equities today.
And speaking of equities, we can't forget earnings season is in full swing, especially for tech.
Critically important this week, 5 of the Magnificent 7 mega caps report. It starts with Alphabet after the bell tomorrow, Wednesday. Given how concentrated today's rally was, those results are absolutely massive for holding these current market levels.
So if you step back and look at the whole picture, low VIX, tight credit spreads, record highs in stocks, it feels like the market is priced for, well, a perfect outcome, doesn't it?
Completely priced for a perfect script. Dovish Fed, progress on trade, amazing tech earnings, and that creates what we call asymmetric risk.
Meaning the downside potential is much bigger than the potential upside from here.
Exactly that. The market's priced for perfection. So any unexpected negative news, what you might call a low probability hawkish surprise, could cause a really sharp reversal.
Like if the Fed hints at pausing in December.
Or if Powell sounds genuinely worried about inflation despite the missing data, something like that could easily trigger a sell-off. You could see the S&P pull back towards, say, 6,700 pretty quickly. And gold. It would likely snap right back up towards $4,100 or higher as that safe haven demand comes rushing back. The market's left itself almost zero room for error.
So it looks calm on the surface, driven by this very narrow AI leadership and trade hopes. But underneath you have these big disconnects between assets. Super low volatility. It suggests the market is betting everything on one very specific, very positive scenario playing out.
And if 2025 has taught us anything, it's that market narratives, no matter how strong they seem, can turn on a dime. I mean, look at gold's massive swing from over $4,300 down below $4,000 in barely a week. That shows just how fragile the current consensus might be. If the market's this vulnerable to a hawkish Fed surprise or a stumble in those trade talks on Thursday, maybe we're seeing the last days of this price for perfection phase.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.